Most traders are doing it backwards. They add to losing trades, hoping the market comes back. They average down. They double up on bad positions. And slowly, quietly, that account starts bleeding out. But the traders who actually build wealth over time do the complete opposite. They add to winners. And I know exactly what you're thinking. Isn't that just chasing the trade? No, not even close. Done right, adding to winners is one of the most powerful tools you have in your entire trading arsenal. Done wrong, it turns a great trade into a disaster, faster than almost anything else. In this video, I'm going to break down exactly how to add to winning positions the right way, so you can ride big moves, protect your downside, and stop leaving money on the table. Let's start at the very foundation. When you add to a winner, sometimes called pyramiding, you enter a trade, watch it move in your favor, and then add additional contracts or shares to that position while it's already profitable. So instead of putting all your size on at once, you are layering in. You start small, the market proves you right, and then you add more firepower as the trade confirms it is going your direction. This is fundamentally different from going all in at one price and hoping for the best. It sounds simple, and conceptually, it is. But the execution is where most traders completely fall apart. Here is the key distinction I want you to lock in early. Adding to winners is about letting the market confirm your thesis before you scale. You are not guessing that the move is coming. You are watching it happen and then pressing your advantage. Think of it like a football player who has already broken through the defensive line. They do not slow down when they see open field. They accelerate. That is exactly what you are doing. You got through the defense. Now you press. But there is a catch, and it is a big one. Every single time you add to a position, you change the math. Your average entry price moves. Your total risk changes. Your break-even point shifts. If you do not track those numbers, you can go from a comfortable winning trade to a losing one in a matter of minutes. And that is exactly what we are going to fix today. Here is the thing nobody talks about. Most people who try to add to winners end up blowing up those trades. Not because the idea is bad, because the execution is broken. There are 3 mistakes I see over and over again. Mistake number 1. Adding too much size too fast. You are up 2 handles on crude oil. You feel great. You add twice the size of your original position. Now you are massively overexposed. Your average entry has moved dramatically, and the moment price pulls back even slightly, you are in the red. You panic. You exit at a loss on a trade that was winning just minutes ago. The fix is simple. Add in smaller increments. If your original position is 1 contract, your next add should be 1 contract. Not 3, not 5. Scale proportionally. Mistake number 2. Moving the stop loss in the wrong direction. This one hurts to watch. Traders add to a winning trade, and then, because they feel confident, they give the trade more room. They widen the stop. Suddenly their risk has exploded. Remember this rule. When you add to a position, your job is to tighten your risk management, not loosen it. Every single add should come with a reassessment of where your stop is. Ideally, you are moving your stop up to protect profit, not widening it to give the trade more space to hurt you. Mistake number 3. Adding at the wrong level. Randomly throwing on more size in the middle of a trend is not a strategy. If you are adding just because you feel good about the trade, you are not trading. You are gambling. Every add needs a logic behind it. A key level, a structural support, a measured move target that has been hit. There has to be a reason, just like your original entry had a reason. If you cannot articulate exactly why you are adding at that specific level, you should not be adding at all. Okay, so how do you actually do this properly? Here is a simple framework that you can apply to virtually any market, but I am going to walk through it in the context of crude oil futures since that is my primary market. Step 1. Take your initial position at your planned entry. This is your core trade. Maybe it is one contract. Maybe it is two. But this is your base. You enter based on your setup, your level, your structure, your reason. And critically, your stop is already defined before you even enter. Let us say you buy one contract of crude oil at a key support level. Your stop is below that structure. Your initial risk is defined. You know exactly what you are risking before you click buy. Step 2. Let the trade move in your favor before you add. This is the discipline part. Do not add immediately. Do not add because it ticked up a few cents. Let the market show you something meaningful. Personally, I want to see the trade at or near at least a 1-hour move in my favor before I consider adding. Why? Because at that point, I have the ability to move my stop to break even or above on my original position. That means even if the whole thing falls apart, I do not lose anything on my initial trade. Step 3. Add at a logical level with a purpose. Maybe there is a new level of support that has formed above your entry. Maybe price has broken through a key resistance zone and is now using it as support. That is your add point. You are not randomly throwing size at a moving price. You are identifying a new entry point that would stand on its own merits if you looked at it fresh. Step 4. Adjust your stop to account for the new position. This is where the math matters most. When you add, your average entry moves up. Your stop needs to account for that. The goal is that your total risk across both positions stays within your risk parameters. So if your max risk per trade is 10% of your account, that 10% needs to cover the combined position, not just the original. Move your stop to a level that keeps your total downside within your defined risk limit. Often this means moving the stop up significantly from where it was on your original entry. Step 5. Let the trade run. This is the hardest part for most people. Once you have added and managed your risk, your job is to hold. Do not micromanage. Do not scalp out early because you are nervous. You built this position because you believe in the move. Let it develop. Some of my best trades have been where I added once, maybe twice, and then just sat back and let crude do its thing. We are talking 1 to 4, 1 to 5, even 1 to 7 risk-reward outcomes just because I had the patience to hold and the discipline to add correctly. I want to get more specific here because I think this is where people get fuzzy, and fuzzy thinking costs money. Let us walk through a real hypothetical. Say you have a $10,000 trading account. You risk 10% per trade, so $1,000 per trade is your maximum risk. You enter one contract of crude oil at a support level. Your stop is set 50 ticks away. At $10 per tick on crude, that is $500 of risk on the initial position. You are well within your limit. Price moves up 50 ticks. You are at 1 R profit. You move your stop to break even on the original contract. Now, you literally cannot lose on that first position. Then you add a second contract at a new level with a stop 25 ticks below the current price. That is another $250 of risk. Your total risk in the trade now is $0 on the first contract because your stop is at break-even, plus $250 on the second contract. Total risk is only $250. You are still well within your $1,000 limit. Price moves another 75 ticks. You are running now. You add a third contract. You move all stops up to lock in some profit. Now you have 3 contracts working. Your original entry is deeply profitable. and your total downside is either zero or a small locked-in gain. That is pyramiding done right. Your risk actually decreases as you add, because you are funding new risk with existing unrealized profit and actively managing that stop. Contrast that with the trader who adds 3 contracts all at once at the beginning with a massive stop and no plan. Same market, completely different outcome. The difference is not the market, it is the structure. Now, let us talk about the part people skip. What happens when you are fully loaded up with multiple ads and the market turns on you? Because it will happen. Not every ad works out perfectly. Markets reverse. Big orders come in out of nowhere. News hits. You need a plan for when your pyramid starts crumbling. Here are the things I actively think about. Rule 1. Never let a winning trade become a losing trade. Once you are up meaningfully on a position, especially after ads, your stop must be at a level that at minimum preserves break-even on the overall trade. Ideally, you are locking in some profit. If the market takes you out, you walk away flat or slightly green. That is the worst case, not a loss. Rule 2. Scale down before you scale out. If the market is showing signs of reversal, slower momentum, failure to make a new high, price action that does not look clean, consider removing one layer of your position before you get stopped out of everything. Take the ad off. Bank some profit. Let the original position breathe. This way, you are not leaving everything to a binary full stop or full win outcome. Rule 3. Be ruthless about your daily loss limit. Even with a perfectly constructed pyramid, if the market reverses hard and fast, which in crude oil it absolutely can, you need to know your ceiling. My daily loss limit is the hard wall I do not cross. Period. Some days, even after a great start, the market gives it all back. If that happens, I stop. I do not revenge trade. I do not try to claw it back with sloppy setups. The daily loss limit exists for a reason. Protecting the downside is not pessimism. It is what keeps you in the game long enough to actually build something meaningful. Let me be honest with you for a second. Knowing all of this is one thing. Actually executing it, when you are in a live trade, watching price move, feeling that rush, that is a completely different challenge. Adding to winners feels counterintuitive. When a trade is moving in your favor, your instinct is often to take profit, not add more risk. You are fighting the fear of giving it back. On the flip side, when you are loaded up with multiple contracts and the trade is running beautifully, greed kicks in. And greed makes you sloppy. You stop managing the stop. You add too much. You convince yourself this is the trade that is going to run forever. Neither fear nor greed is your friend here. The antidote is process. Having a predefined set of rules, exactly the kind we walked through, means that when you are in the heat of the moment, you are not making emotional decisions. You are executing a plan. Before you even enter a trade, ask yourself these questions. If this goes to 2R, where would I consider adding? What level would justify an add? What would my stop need to be? What would my total risk look like? Do that work before the trade, not during. Because during the trade, your brain is flooded with emotion and adrenaline, and it will lie to you. Plan the trade, trade the plan. So let me wrap this up. Adding to winners, pyramiding, is one of the most powerful moves you can make as a trader. It is how small positions turn into big outcomes. It is how a 1-to-2 trade becomes a 1-to-4 or a 1-to-7. It is how you actually build account equity over time instead of grinding out tiny wins. But it only works if you respect the mechanics. Start with a core position. Let the market confirm the move. Add at logical levels with a purpose. Adjust your stop to account for the new size. Never let your total risk blow past your limit. And be ruthless about protecting profit once it is there. The market does not owe you a big winner. But when the setup is right, and you have structured the trade correctly, and you have had the patience to add intelligently, you want to make sure you are positioned to take full advantage of it. Because those are the trades that change your account, and they do not come around every single day. So when they do, you want to be ready.